Corporate Finance Excel practice problem. In this presentation, we're going to work a practice problem in Excel related to the calculation of net profit margin and return on assets, this time having a comparison between subsidiaries or divisions within a company. Get ready, it's time to take your chance with corporate finance. Here we are in Excel. We have our information on the left-hand side. We're going to put that into the blue area into our worksheet on the right-hand side, calculating for different divisions or subsidiaries the net profit margin or return on sales, return on assets or ROA, and then the return on assets for the entire company. We'll be doing a comparison within the company now or within the subsidiaries of the company. In other words, thinking about a company or a parent company, which then has the divisions within it, which may even be subsidiaries, meaning other companies that are owned or have a majority share ownership or a controlling interest by the parent company. So we're looking at these different divisions and we can think about how they're doing in comparison to one another. When we do this, we're often thinking about, in this case, divisions that are somewhat independent. In other words, they have revenue and expenses to some degree independent. If you're thinking about, in other words, different centers or different departments within an organization that aren't independent, you might have like a cost center versus a profit generating center, and you might need different kind of measurement tools in order to measure those types of centers, because one is going to be based, one center might not have revenue generation if you're measuring something that's just basically a cost center. But if you're measuring completely different divisions or subsidiaries, then you're talking about divisions that are running somewhat independently, and therefore you can use the similar kind of measurement tools as you would for a separate company in general, including measuring their profit margin or return on assets. All right, so we've got our information: sales, net income, and assets. We're going to take a look at the the return on sales or the net profit margin, which is going to be the net income. So we're going to be picking up the net income performance, and then we're going to be comparing that to the sales performance top line. We're comparing an income statement account to an income statement account. That means we're doing the same kind of timing analysis, meaning for the range, if it was a year, for the year, rather than comparing a balance sheet account to an income statement account. Therefore, we don't have some kind of issue with trying to equivalate the two by having some type of average. We're going to be then taking the net income bottom line number, dividing it by the sales, the top line number on the income statement. We're going to say this equals the top line divided by the sales. Let's add a percentage there, go into the home tab, the numbers group, and percent. We'll add some decimals. Again, you can add more decimals. We'll typically need to stop somewhere. We're going to generally stop at 2 decimals. Going to put an underline here, so under the sales, so home tab, font group, and underline there. So then we're going to do a comparison. We're going to say, okay, the return on sales is 8.7. How does that line up with the other divisions or subsidiaries? We're going to say this is going to be equal to the net income for B. We're going to compare that to the sales for B. This is going to be equal to the net income over the sales. Let's format paint this now. I'm going to select these two cells, home tab, clipboard, format painter, format painting these two cells. All right, so now we're saying this ratio, we would like this ratio to generally be higher, because that means that A, for every sale that's happening, they're walking away with every dollar sale 8.7 cents, 8 or 9 cents. Or if we have every 100 sales, you're keeping $8.70. And B, for every dollar sale sold, you got 4 cents, about 4 cents. Or for every $100, you've got $4.03. So in terms of the return on sales or the net profit margin, A is looking better there. Okay, so then we're going to go to C division, and we've got the net income, and we're going to divide that by the sales. Dividing this out, this equals the net income divided by the sales. Let's do the format painter, selecting the prior two cells, home tab, clipboard, format painter, paint brushing, then over here. And so there we have it. Now we're at 8.31. Again, the larger number would typically be better. So we're thinking here that A has the highest return on sales or the highest net profit margin. So note, we can do that comparison even though if we were looking at these three divisions and we have our company, meeting where we're comparing these three divisions or these three subsidiaries, we can't really compare their net income in total because they're substantially different, right? A's got substantially more net income, so we can't really compare performance-wise in that way. The sales, of course, are a lot higher for A, but we can try to compare something like the ratio analysis. So we could think about the company meeting. We're comparing these three divisions. We're saying, yeah, A is a lot bigger, but they're also have a bigger profit margin, which is good, right? So they're doing good there. And then C and then B on the profit margin. Let's take a look at the return on assets now. Return on assets, how efficiently are we using the assets per division? So we're going to take this. This is going to be the net income divided by the assets. Net income divided by total assets. So we're going to be, and remember net income meaning income statement account, performance account, assets being a balance sheet account. And therefore, we're comparing something that's got a range of time versus a point in time. So you might see the assets being average assets here, so just be aware of that. So we're going to be picking up the net income for A and comparing that to the assets and dividing this out. This is going to be the net income divided by the assets. Let's make that a percent. We're going to go to the Home tab, numbers, make it a percent, add some decimals. You could keep on going. We're going to stop at 2. So we've got the 20.46. Let's go ahead and underline here. We're going to go to the Home tab, font group, and underline. And so that's going to be our return on assets. Is that good or not? Well, it depends on industry standards and on past performance. And in this case, in relation to the other divisions, we're comparing to the other divisions to see how they're performing relative to each other. So then we're going to compare B, where we've got the net income divided by the assets. And so this is going to be equal to the 225 divided by the assets. We're going to copy the formatting of these two cells, Home tab, clipboard, format painter. Going to paste that over here. So it looks like obviously here A is doing far better in terms of using their assets efficiently than B does. B has a substantial amount of assets, similar to what A has, and yet their net income is much lower than A. So A's looking better there. And then we're going to say C is going to be 368, dividing that by the total assets. This equals the 368 divided by the total assets. Let's go ahead and format paint this, selecting these two cells, Home tab, clipboard, format painter. We'll paste that over here. So we're at 1085. So obviously C is kind of in the middle here. So C has more income than B, but not like substantially more. Far less than A, which is looks like a lot larger division. But C is doing that income with a lot less assets involved. So therefore their return on the assets is a lot higher. So it looks like we're allocating a lot of assets to B, and they're not generating as high of a return there. So if you start to look at this, you might be saying, well, okay, why is B not generating the high return? Would it be possible that we can take some assets from B without hurting the, and let them keep rolling along and give them to C, and would that increase C's return? I mean, if they had more assets, would they be able to increase their net income so that their return on assets remains the same, but we reallocate some assets over here? Or could we reallocate some assets to A, which it looks like they're getting a 20.46, and it depends on the circumstances of the company. Does it look like we could use more assets there and still have that increase the return or not? So those are some of the questions that you might think of basically internally if you're thinking of like a managerial decision-making process. And of course, this is only one ratio or two ratios here that we would look at. You can consider more breakdown there. If we look at the company total then, and we look at the return on assets in terms of total, we can compare the divisions compared to the total. So I'm going to paste this like that. So we got the net income compared to the assets. We can say, okay, let's take the total. I can sum these up. I'll do it this way. Equals the sum of the net income for the three divisions, assuming that's the total company. And then I'm going to compare the assets equals the sum of the assets. And then say this is equal to this divided by this, the return on assets for the company. Going to go to the home tab, numbers, make that a percent, add some decimals. Let's put an underline here, home tab, font group, underline. So for the return on assets in total then is going to be 11.23. Obviously A is kind of pulling up that average here. And then B's quite far under it, and C's somewhat close to the average for the company, or the company return on assets total.